Okay, fewer than 8 minutes to go before the closing bell rings, and suddenly we are seeing some green on the screen here. The Dow was up most of the session, up 143 points right now. S&P holding on to about 8 points. Let's see if that can hold in the next 8 minutes. And we've got the Nasdaq up 28. Russell still languishing to the downside by 23 points. Next Wednesday, the Federal Reserve wraps up its two-day interest rate setting meeting, so cancel all plans and watch Fox Business, because who knows what the markets are doing. Well, the markets right now are pricing in no cut at the June meeting. That hasn't changed, but there's now an 18.5% chance of a cut in July. And of course, September, we always knew was going to be the first, but now July? Weird. Our countdown closer says not weird. The Fed should cut sooner rather than later, and he thinks there is a scenario where we would see a July cut. He is Allianz Chief Economic Advisor and former CEO of Pimco, Mohamed El-Erian. He is also, of course, head of St. Anthony's College, and that's where you went, and president of Queens College. July? Is this real?
That's what they should do. Will they do it? Probably not. We've got a Fed that was so traumatized by the big mistake they made in 2021, where they took a strategic view of the economy and got it completely wrong, that they only look at past data. They're data dependent. They're excessively data dependent. So because they are so reactive, we're not going to see it in July, but we should see it in July.
But why should, Mohamed? We have data that still show a muscular, when it comes to statistics, a muscular economy. And I mean, it's not Arnold Schwarzenegger muscles, but it certainly looks very solid. Today we got the JOLTS report. Sure, it missed estimates, but we still have 8 million jobs at the moment that are open. We're getting the May jobs report on Friday. Tomorrow we get the non-manufacturing services PMI. That's where we've seen the stickiest inflation. Why should we cut in July?
So tomorrow's data, really important, because the service sector has had a big influence on inflation, but also on growth, and it's a major engine of growth. So we can talk again after tomorrow, but so far we've had disappointing retail sales, we've had disappointing PMI manufacturing numbers, the ISM numbers were disappointing. Today's job vacancies were considerably below expectations. You know, Citi has this index of surprises, and we've had nothing but negative surprises. And all that is saying to us is that the economy is slowing much faster than most people expected, including the Fed.
You think that retail sales have been misses? I mean,
we saw the number last Friday.
But you know that Jay Powell goes by threes. He wants to see a trend rather than just, well, not even threes. I mean, he'd like to see much longer trend, right, before he makes a move.
And that is where the policy mistake comes in. Monetary policy acts with a lag. So you are really targeting the economy of tomorrow. But if you do that based on yesterday's data, you're likely to get it wrong. But I understand why. You know, Liz, they got 2021 so wrong when they decided inflation was transitory, when people, including us, were telling it's not transitory, pay attention, that they're afraid of making a major strategic call. And I think that is where we have the risk right now.
Well, the risk is there, but when we talk about inflation, it's not just services, it's the cost of shelter, housing. Very sticky. How do you get that down without causing a mistake?
So again, interesting data. In the last few days, listings are going up. So for a long time, people held back from putting their homes on the market, and the inventory was really challenged. And that meant that, ironically, prices went up, even though interest rate had gone up enormously. We had never seen that before. Now we're seeing supply coming onto the market. So I think you're going to see most of the major components starting to correct. But will that happen in time? That's the big question.
Well, pending home sales came in down 7.7%, actual down 0.6%. So yeah, Case-Shiller, prices are still hot.
They are, because we didn't have enough inventory. I think that's going to change as well.
What else will change? And we've been talking about AI. We just spoke with Seb of Klarna, and he has wrung $10 million in cost savings by using AI. When you say cost savings, let's be honest, that means he doesn't have to pay people anymore to do some of these things. How will that affect the economy? Have you modeled for that?
So if you look at what's ahead of us, there's a 50% chance we soft land, meaning inflation comes down and we sacrifice some growth, but not too much. There's a 15% chance that generative AI, life sciences, all these revolutions actually make us bigger but not hotter, meaning we can grow even faster but without inflation. And there's a 35% probability we're going into recession. So that is what we're looking at. So if you're an optimist, you will add 50 and 15 and say there's 65% of something good. If you're a pessimist, you'll look at 35% of recession and say that's so high. That's really important for the investors. Investors have to embrace the whole distribution and recognize that this is what we're looking of. This is a very uncertain economy. Remember, we entered 2023 with people saying 100% of probability of recession, and the US economy surprised on the upside. Unfortunately, we entered this year a little bit too rosy, and now the economy is slowing.
We should show either a 2-year or a 3-year of all the major indices so that we can indicate how the market has continued to climb as inflation has come down from 40-year highs of June 2022, right? So what do you think happens when the Fed finally does cut? Is it sell on the news?
So I think a lot of it is priced in. But what's important is that you have got some major developments at the corporate level. So if you look at the Magnificent Five, they have a very strong secular tailwind. They are actually doing things that are changing not just what we do, but how we do it, and they have a long runway. You can tell lots of good stories, and that's been keeping the market up, and earnings have been keeping the market up.
Am I hearing you say buy those 5?
I'm saying, look, you've got to keep an eye on valuation, but if they do sell off, they certainly will be interesting. The other thing we've got to figure out is interest rate expectations. We entered the year thinking the Fed, the market, thinking the Fed was going to cut 7 times. Then we reduced it to 1. Now we're at 2. We've been all over the place, and it just shows you this is a really difficult economy to forecast.
We got 10 seconds. 2 or 3 cuts, or 1 this year?
I hope we get 3. I suspect we'll get 1 or 2.
Mohamed, great to have you.
Thanks.
And you said we can talk tomorrow after the data come out. You're always welcome back every 24 hours.
Thank you so much, Liz.